Let's delve deeper into one of the pillars of the strong housing trade, mortgage rates at record lows. Our next guest is asking, though, if the Fed is propping up the housing market. Let's bring in Peter Bookvar, CIO of Bleakley Advisory Group and a CNBC contributor. Peter, you wrote about this in your note this morning. And of course, we know that the Fed buys, $40 billion in mortgage-backed securities a month still, even with mortgage rates at low. So what is the Fed's role in all this?
Well, now we're seeing annual home price increases of about 7%, with CPI running at about 1.5. That's obviously more than 4 times. So we're seeing home price inflation that's obviously being juiced by low mortgage rates. But we're at the point where the aggressive rise in prices is offsetting the benefit of lower mortgage rates. So there's really no win anymore to the low mortgage rate. And while it's lowering your monthly payments, that's being offset by the higher principal that you have to pay. In addition to, for that first-time buyer that's trying to save up for that down payment, you annualize 7% increases a year, there's a higher down payment that's needed. So I argue that the purchases that have compressed mortgage rates to such an extent where the Fannie Mae U.S. Treasury spread in January was about 1 to 2 basis points. It blew out to 70 back in March. And because of Fed buying, they basically compressed it now back to 0. But now that we're inflating home prices, we're at risk at hurting the market rather than helping it, particularly from that first-time home buyer.
How worried should we be about this, Peter? I'm asking this question because doesn't this ultimately correct itself? Buyers don't keep buying homes at 7% year-on-year increases. They cap it. And then people, or sellers, I should say, not just people, they ratchet down their sales prices. Doesn't this self-correct?
I hope that's the case. When you look out over the next 5 years in housing, the millennials are the biggest demographic powerhouse that is going to drive the housing market. Well, we have to make it affordable for them to buy. And that's not just on the mortgage side, but it's on the price side. So I would argue a healthier housing market would equate to a slower pace of price increases. But the Fed is going to have to explain themselves that with these sort of price increases that is potentially pricing out that first-time buyer. And as you mentioned earlier, Toll Brothers CEO saying that buyers are getting sticker shock. The Fed is going to have to tell us why they think it's a benefit to the market to be buying $40 billion a month in mortgage-backed securities still. And that they own more than a third of that market. They're at risk now of Japanifying that market. By dominating that market to such an extent, it scares off private buyers, and they sort of break that market in terms of its functionality.
Peter, it's the same as the Fed buying high-grade corporate debt. Why are they buying Apple's debt? So I'm totally with you on this, and I think your thoughts are always right out in front on this. What's the next asset that they're targeting? Because we're creating the mother of all housing bubbles. We're creating arguably a stock bubble. And when do they get comfortable with what they've done to asset prices, even if they claim they have no inflation?
Well, we'll know for sure next week, because there's obviously chatter that, at least on the Treasury side, that they're going to extend out the maturities of their QE5, I call it. But if they sit and do nothing and they just leave it as is, maybe that's their first sign that, we've done enough for now. And I think in 2021, because we keep in mind, what they're doing now is a COVID world. Next year, we obviously hope is a post-COVID world with that vaccine. So how is the Fed going to substantiate doing the same exact policy next year that they were doing this year? And ironically, for a while, the Fed was saying we hope to transition our portfolio to a Treasury only and away from mortgage-backed securities. And then obviously the first hint of trouble, they're right back in diving into the mortgage-backed security market to the point that they're dominating it now more so than they did in the early, in 2010.
Just quickly, Peter, what are the odds in your view that the Fed doesn't, expand the amount of assets purchased, but simply shifted away from mortgage-backed securities to longer-dated treasuries?
I think you hit it right on the head right there, that is what they will likely do if they do something. They are not going to be increasing the size of it, but recalibrating it is definitely a possibility, as you speculate.
All right, Peter, great to speak with you. Thank you.
Thanks, Melissa.
Peter Bookvar, I know we use the term bubble fairly loosely. But Guy, do you think this is a bubble in that homeowners have more equity than they did in the past housing bubble, to the point where they wouldn't be in trouble if rates went higher?
Yeah, it's interesting. I'm not going to go that far, but what I will tell you is there's clearly the Fed is creating a bubble in asset prices across many, many different things. I mean, just look at what's going on in Bitcoin. Look at there was a secondary priced by MicroStrategies, I think, and the sole purpose of that secondary was to buy cryptocurrencies. I mean, if that's not a sign of excesses, nothing else is. So I think the Fed has created bubbles across all asset prices. I'm not suggesting we're in a housing bubble, but we're damn close, I think, Melms.
What happens, Steve, to the housing trade broadly, as we've talked about it, whether it be furniture sellers or hardware stores, et cetera, if mortgage rates tick higher, if the Fed steps away and allows mortgage rates to go up?
Oh, without question, all of these stocks come in. If you look at Lennar's up 29%. All of these names are up between 20 and 40% if you look at the housing market. And even Home Depot and Lowe's, when we were in the throes of COVID, there were lines around the street at my local Home Depot. So there's a lot that was pulled forward. If rates increase, now let me give you one caveat. Every housing recovery happens in a rising rate environment. But this is not a housing recovery. We pulled forward a lot of that demand. So I think a lot of these stocks come in dramatically.
Shepard Smith here. Thanks for watching CNBC on YouTube.